So Alibaba is likely to be one of the biggest US IPOs this year. It's valued at about 20 billion US dollars. And it's generated a lot of excitement because the Chinese e-commerce is both bigger as a proportion of its market than the US, and it's growing faster. So right now, to give you some figures, in China, probably about 8% of shopping is done online versus maybe 6% in the US. And Alibaba itself figures that that could grow to almost 30%, which explains the high valuations. So one thing about Taobao is that each shop has its own storefront, I guess you'd call it. And shop owners can decorate it or change it, change the look, change the feel to try to attract more people to come to that. And that reflects the fact that Alibaba doesn't actually own the goods it sells. It takes a fee. The retailers, the online retailers, take all the risk. So that's a bit of a different business model. And you have lots of people who've left their jobs and tried to set up shops on Taobao. They have maybe selling funky handbags or some sort of fashion item. Other people selling imported goods that you can't get otherwise. Not all of these have been a success, but lots of people have tried. And the other big advantage is if you're a small factory, a small shop somewhere in the provinces, you can reach your consumer directly, so you can get a better margin that way. They account for about 4/5 of the Chinese e-commerce market, and it's easy to see why, because you might think 30% sounds like crazy growth, but in fact we do a lot of our shopping online. The reason is that most Chinese shops are either really low-end, cheap, low-quality goods, or extremely expensive luxury goods that you don't really want. So we go online. We buy all our diapers online. We bought my son's bed online. You can find anything, really. I mean, take a look here. Yak milk powder. Do you want yak milk powder for your kid? If so, you can buy it on Alibaba, on Taobao, which is the consumer-facing version of Alibaba. So one thing about this Alibaba listing, one of the big unknowns, is the risk, and that is that you don't own a share of Alibaba directly, unlike many, say, American companies who are listed in the US. Instead, what you're going to get is something called a VIE structure, which basically means that they have put their assets in a series of shell companies incorporated in tax havens, and you buy a share of that. That's to get around some Chinese government regulations, but it's a structure that some investors are uncomfortable with.